more than 2.4 million shareholders in Lloyds, are to get a £3.2 billion payout after Britain's largest bank notched up its biggest profits in a decade. The bank's army of small investors will be handed the cash through a dividend and a £1 billion share buyback. Lloyds raked in £5.3 billion last year, up 24% on 2016. Chief Executive Antonio Horta-Osorio also saw his pay rise from £5.8 million to £6.4 million, putting him on course to be Britain's best-paid bank boss this year. It came as Lloyds unveiled a £3 billion investment in its digital and high-end investment operations. The new focus on internet banking is likely to pose a fresh threat to branches, with one analyst predicting 350 could shut. On top of this, it is pledged a push to pick up 1 million more pension customers and boost its investment arm. Horta-Osorio has fought to save cash since taking charge in 2011, shutting a third of the lenders, outlets and axing 30,000 jobs. It is handing out a total ordinary dividend of 3.05p per share, up 20% on 2016, and another 1.4p per will be given to investors who take part in the buyback, for a total of 4.45p. The £3.2 billion bonanza is the highest since the financial crisis and marks Lloyds' return to private ownership after its state bailout in 2008. Millions of ordinary families own the stock, with an average of 6,000 shares, meaning they could get £267 each. Retail banks make money by taking savers' deposits and lending them to borrowers.The rate paid to savers will be lower than what borrowers are charged, and the gap between the two is measured by the so-called net interest margin. When this is higher, lenders make more cash because they keep a greater share of income instead of giving it to savers, and it typically rises when the Bank of England puts its base rate up. Bank of England Governor Mark Carney has signaled that rates will continue to go up, meaning more profit for Lloyds. But boss Antonio Horta-Osorio denied putting the squeeze on savers and vowed to pass on rate rises. He said, "We will probably see prices going up for savers." Lloyds wrote off £795 million of bad loans in 2017, up from £645 million, largely due to its £1.9 billion acquisition of credit card firm MBNA. Total lending rose by £6 billion to £456 billion, but the bank cut back on high-risk mortgages. The total size of its book, where homeowners have a deposit of 20% or less, dropped by £1.7 billion to £30.7 billion. Lloyds set aside £600 million for customers sold useless payment protection insurance on their credit cards, taking its total annual bill to £1.7 billion.